characteristics of a liquid market. Why is it important? Because you're learning this topic of execution of portfolio decisions, we need to know what would be the best time to actually trade a security. In this case, I'm not specific about participating in the stock market. I'm talking also about the fixed income market. So it is important for us to learn about the characteristics of a liquid market so that we can be able to know when not to trade. So the first characteristic of a liquid market is that there are large numbers of buyers and sellers in the market. Large numbers of buyers and sellers in the market. What are we saying? We are talking about participants. Compare a scenario like so, when this is the market that is existing, when there are few participants in the market, they have like an authority in terms of controlling the market prices of securities. So they have an influence in saying that this stock over here is going to actually cost them 300 shillings or 500 shillings. But compare that scenario where you have many players, buyers and sellers in the market like that. It's only the prices of securities or the prices of assets are going to be dictated by this common graph that you know. This is, of course, price. This is time, demand and supply curve. And there is this equilibrium price that is going to be arrived at, that the price at which both buyers and sellers agree that they'll be able to actually trade the security. So if there are a large number of buyers and sellers in the market like this, then it means that that market, the prices of securities or the prices of assets will fully reflect all available information pertaining to that security. So that's what I'm saying, that first characteristic is that there has to be a large number of buyers and sellers in the market. Number two, we're saying that investment characteristics, so investment characteristics are diverse, or investors' characteristics are diverse. Investor characteristics are diverse. What do you mean? That investors have got choices to choose from. The same way you'd be able to walk into a hotel that has got a buffet and pick the choicest pieces from what you feel is going to really help your body. So you'd be able to pick maybe, say, fish fillet over here. You'd be able to pick maybe the brown ugali like that, and you'd be able to pick also some greens so that it can be able to actually satisfy, first of all, your inner self in terms of satisfy your stomach, and number two is going to be beneficial to the functioning of your body. So in a similar manner, we're saying that investor characteristics are diverse. They can be able to choose these securities like that, or these asset classes based on what they feel is going to be beneficial to them. So we're saying they could be able to choose equities. They'd be able to also choose alternative investments. And of course, alternative investments have got 5 asset classes over there. We're talking about hedge funds, private equity, we're talking about real assets, we're talking about commodities and structured products. Those are the 5 asset classes under alternative investments. Then we're also saying you can also choose from fixed income. You can be able to also choose from other asset classes that be able to satisfy your objective. That is what we're saying, that investor characteristics are diverse. As well, we're also saying that one investor may decide to select equities because it actually satisfies their objectives. Other investors can be able to choose alternative investment. So their characteristics are diverse, are different, and are driven by behavioral biases there. Number 3, we can say that they can be characteristic. One of the characteristics of a liquid market is that the convenience trading platform. I said convenience, I actually meant convenient trading platform, where buyers and sellers or participants, market participants, can be able to have access to securities with relative ease. So in Kenya, we're using what we call the automated trading system, where it actually links different market participants, including the brokers and the dealers, brokers and we can say investment banks, with other brokers and investment banks like that. So on behalf of the client. So this is the way it works. So this is the intermediary over here. So one broker, is linked with another broker, of course using the ATS, automated trading system. This broker wants to trade KQ shares or wants to sell KQ shares, and it has to place that order onto the automated trading system. That automated trading system is able to identify another broker who is willing to buy. I said this one wants to sell, I think I said buy. This broker wants to sell a security KQ shares on behalf of the client. This broker wants to buy KQ shares on behalf of the client or the investor. So the automated trading system provides a convenient platform where participants can actually place their trades. That is another characteristic, very key in financial services or in financial markets there. Number 4, we are saying that we have low transaction costs. Low transaction costs. And of course, because our subtopic over here is costs of trading, so transaction costs is what we're going to actually try and analyze, both implicit and explicit costs. Just in a bit, going to analyze that. So these are the characteristics or the major characteristics of a liquid market. Large numbers of buyers and sellers in the market, participants. Investor characteristics, so the key word here is large number of buyers and sellers. There. Investor characteristics are diverse. They're different from my needs to other people's needs. Convenient trading platform. There is unique, is very important there. And low transaction costs over there is the key word there. So those are the major characteristics of a liquid market. So what are the factors that would lead to market illiquidity? And it's obviously the contrary opinion on this. So we're saying what will lead to market illiquidity is that if there are few numbers of buyers and sellers in the market. Number 2, investor characteristics are not diverse. It means that investors think based on behavioral finance, and the traditional finance view based on behavioral finance. Please look at that topic on behavioral finance under corporate finance, and you'll be able to recall that you actually mentioned, it was actually mentioned that investors have, the traditional investors think that they are rational beings. They're supposed to think in the same way like a robot. So if you're supposed to think in one particular way like this, KCB shares is going to rise like this based on the information that is provided to the market like that, all investors think the same way like that. That is the traditional sense of viewing things. But now, the modern way of viewing things is that investors' behavior or investors' thinking capacities are different like that, and it needs to be appreciated that. Then, we're seeing we're contributing towards market illiquidity, the high transaction costs. So for transacting or buying and selling of securities, we're saying that it actually leads to a market illiquidity, high transaction costs. So the costs of trading is actually high, both implicit and explicit costs.